Here's what investors do not want: additional risk, highly leveraged investments, principal paid back instead of earned income. They don't want to get their principal back. Now, there's a fund called Ginnie Mae funds. They pay back principal and interest. You know what the investors do when they get their principal? They spend it. Half of them haven't been told that they're spending their principal. It's not good. If you tell the person you're going to get back principal maybe for the first 6 months or whatever, and then it's going to be interest and real earnings. That's what the investor wants. He doesn't want to see his basis reduced when he returns principal, unless it's in a large lump sum, which is refinanced. The investor does not want unrealistic promises made by unproven syndicators. It's a nasty statement, guys. I'll say it again. Promises made by unproven syndicators. Undersell your deal on Wall Street. If you think it could be 3 to 1, you're going to return $3 for every dollar, get $3 back for every dollar you put up, sell it down to 2. Surprise them on the other side, because the investors have been so beat up with the other surprises where they've lost their money. Bait and switch. If you say you're an expert in Tampa or South Beach, don't start loading in deals from Detroit because you got a great deal. You know, part of the blind pool. It won't fly. Investors don't like but have to live with complex prospectuses. And it's an oxymoron to say I can make a simple prospectus. It's just impossible. So try not to make it too much boilerplate, but there's certain limitations that your attorney has to put into it. He has to put so many things in small print. I think it was said this morning, nobody reads him except the due diligence officer and the other attorney who's suing him. Those are 2 people who read him. I would actually say, of the thousands of prospectuses that I've handed out in my years in the business, I really doubt if 5% or 2% are read. It's unbelievable. All that paper is just there. Too complicated. Deal breakers are high upfront loads and bad deals on the back end. Another thing that totally ticks off an investor, any investor, if your CPA cannot file on time and ask for an extension, a K-1 extension or whatever type of thing you're putting together, that's going to tick off the investor because now he's worried. What's causing the problem? How come they can't report? Now will the IRS look at me because I filed an extension? You know, just go up to that CPA and say, look, you have a job as long as you can file on time. The day that you have to file an extension with me is the day I'm hitting another CPA. You'd be surprised that you're going to get your statements in on time.